Have you ever wondered why some people become wealthier every time the stock market crashes, while everyone else panics and sells? It sounds unfair, doesn't it? Imagine waking up tomorrow and seeing headlines screaming, stock market crashes 30%. Social media is full of fear. News anchors are predicting the end of investing. Your friends are selling everything they own. But here's the strange part. The world's greatest investors are probably doing the exact opposite. So why does this happen? Why do stock market crashes exist? And more importantly, how can you build a portfolio that survives crashes instead of being destroyed by them? By the end of this video, you'll understand why market crashes happen, how smart investors prepare for them, and the simple portfolio strategy that can help you stay calm when everyone else is losing their minds. Let's begin. First, let's understand what the stock market actually is. Many people think the stock market is just a giant casino where prices randomly go up and down. It's not. Every stock represents ownership in a real business. When you buy a share of a company, you're buying a tiny piece of that company's future earnings. Over time, if the company grows, your investment has the potential to grow too. Simple enough. But then, why do markets crash? Here's the truth that surprises most beginners. The stock market doesn't crash because businesses suddenly become worthless overnight. It crashes because human emotions move faster than business fundamentals. Think about it. If people believe a recession is coming, many investors start selling. That selling causes prices to fall. Seeing prices fall makes more people panic. More panic creates more selling. And suddenly, fear becomes a chain reaction. The market isn't only driven by numbers, it's driven by psychology. Fear spreads much faster than confidence. History has shown this again and again. Whether it was the dot-com crash, the financial crisis of 2008, or the market drop during the COVID pandemic. Investors who panicked often locked in their losses. Meanwhile, investors who stayed patient were rewarded when markets eventually recovered. Now, here's something even more interesting. Crashes are not unusual. They're actually normal. The stock market has experienced corrections, bear markets, and crashes throughout history. Yet, despite all those setbacks, broad markets have recovered over long periods and continued reaching new highs over time. That doesn't mean every company recovers. Some fail completely, which is exactly why building the right portfolio matters. So let's talk about portfolios. Imagine you're carrying all your money in one backpack. If someone steals that backpack, everything is gone. Now imagine your money is spread across several secure locations. Even if one location has problems, you're still financially protected. That's exactly what diversification means. Instead of betting everything on one company, one industry, or one idea, you spread your investments across many businesses and sectors. This doesn't eliminate risk, but it can reduce the damage from any single investment performing poorly. Here's a mistake many beginners make. They find one company they believe will become the next big thing. They invest everything into it. Maybe it works, maybe it doesn't. But investing isn't about guessing correctly once. It's about consistently making decisions that improve your chances over many years. That's what professionals focus on. Probability, not prediction. Now let's build a simple portfolio mindset. Imagine your portfolio has 4 pillars. The first pillar is large, established companies. These businesses often have stable earnings, recognizable brands, and long operating histories. The second pillar is growth companies. These businesses may grow faster, but they can also experience larger price swings. The third pillar is international exposure. Different countries grow at different times. Owning investments outside your home market can reduce concentration risk. The fourth pillar is defensive assets. Depending on your goals, these might include cash or high-quality bonds, which can provide stability during periods of market stress. The exact mix depends on your personal goals, timeline, and risk tolerance. There isn't one perfect portfolio for everyone, but having diversification is usually stronger than relying on a single stock. Now let's discuss something almost nobody enjoys hearing: The biggest threat to your portfolio usually isn't the market. It's your own emotions. When prices rise rapidly, people become greedy. They believe markets will never fall again. When prices collapse, they believe markets will never recover. Both feelings are temporary. Successful investors build systems that prevent emotional decisions. One of those systems is investing consistently. Instead of trying to perfectly predict the best day to invest, many investors contribute money at regular intervals. Sometimes prices are high, sometimes they're low. Over time, this approach reduces the pressure of trying to time the market perfectly. Another powerful habit is ignoring daily market noise. Financial news exists to grab attention. Fear gets clicks. Excitement gets views. But successful investing usually isn't exciting. It's often boring. It's patient. It's disciplined. And that's exactly why so few people stick with it. Here's another important lesson. A portfolio should match your life. If you'll need your money next year, taking significant stock market risk may not be appropriate. If you're investing for retirement decades away, temporary market declines may matter less than they feel in the moment. Time changes how risk works. The longer your investment horizon, the more opportunity there has historically been for markets to recover from downturns. Now let's return to crashes. The next time the market falls sharply, remember this. Prices falling doesn't automatically mean businesses have stopped creating value. Sometimes fear pushes prices lower than fundamentals justify. Sometimes companies genuinely face serious problems. The challenge is knowing the difference. That's why many long-term investors focus on diversified portfolios instead of trying to predict which individual stock will be the next winner. Because nobody consistently predicts every crash. Nobody consistently buys at the absolute bottom. Nobody consistently sells at the absolute top. Even the best investors get things wrong. The goal isn't perfection. The goal is consistency. If you can avoid panic, stay diversified, continue learning, and make decisions based on long-term thinking rather than short-term emotions, you've already placed yourself ahead of many investors. Remember, building wealth is usually less about finding one magical stock and more about developing habits that you can repeat for decades. That's what creates lasting results. Before you leave, I want you to think about one question. If the market dropped 30% tomorrow, would you panic or would you see an opportunity? Your answer says more about your investing future than any stock tip ever could. If you enjoyed this video and want to learn more about investing, building wealth, financial psychology, and understanding how money really works, make sure you subscribe to Richard Hayes Official, because every week we're breaking down complex financial topics into simple ideas that anyone can understand. Thanks for watching, and I'll see you in the next video.